So shares are bought for 80,000. Acquisition costs are 4,000. They are sold for 130,000. The selling costs are 3,000. What is the taxable capital gain? One thing you should take note of is that here we are talking about shares. With shares, indexation does not apply. What we do with shares is that we calculate the gain and take 75% of the gain. That's how we treat shares. With shares, indexation does not apply. We only calculate the gain and then we take 75% of the gain. To calculate the gain, we use this formula here. We say sale value is the sale value minus the acquisition cost minus the cost of sales minus the selling cost times 75%. Like I said, with shares, we don't really calculate we don't really calculate indexation. Indexation does not apply with shares. We just determine the gain and then we multiply it by 75%. We take 75% of the gain. So this is the formula that we'll be using here. So here, our sale value, we get it directly from the question. Here's our sale value. They are sold for 130,000. Then our acquisition costs. Our acquisition costs are made up of the 80,000 which the shares were bought for, and the acquisition cost of 4,000. That's our total acquisition cost is minus 4,000 and minus 80,000. And then again, what do we do also? We then subtract our selling costs. We are told from the question there that the selling costs are 3,000. So we'll do it like this. Is 130,000 or is our sales value 130,000 minus our acquisition costs. I said our acquisition costs are made up of 80,000 and 4,000. So I'll treat them as 84,000. 84,000 of our acquisition costs minus our selling costs. Our selling costs of 3,000 minus 3,000. That should give us what? A 43,000. And then we multiply by what? By 75% times 75%. That should give us 32,250 as our net gain. So take note of this. With shares, indexation does not apply. When we want to calculate the capital gain for shares, we don't apply any indexation rules. We just determine the capital gain, then we multiply it by 75% because only 75% of that gain will be taxed. Then we move on to question 2. A property costs 200,000 and acquisition costs are 20,000. The index factor from the acquisition to disposal is 1.10 and the property is sold for 320,000 and the selling costs are 5,000. What is the capital gain? So yeah, now we are calculating capital gain for an asset, not shares. So in this sense, indexation is going to apply. This is how we are going to tackle it. For property that is not shares. For property like assets, we use the formula here. We say is the sale value minus the indexation cost of acquisition minus the selling price minus the selling cost. So use this formula here. Is the sale value minus the index cost of acquisition minus the selling cost. So we'll treat it like this. We have our selling price there. Sold for. This is how you identify your selling price. You hear that something was sold for what? That's your sale value, not selling price. That's your sale value. So here our sale value is 320,000. 320,000. 320,000 minus, like I said, with indexation is a bit different. I are dealing with property. I want to treat it a bit differently. We're going to use the index cost of acquisition. Here we are told that a property costs 200,000 and acquisition costs are 20,000. Okay, so we might as well assume that it's not even an assumption. Our acquisition costs are 200,000 plus 20,000. That should give us 220,000 as our acquisition cost. 200,000 plus 20,000. Now, I said we are going to be using the index cost of acquisition. We determine the index cost of acquisition by multiplying our acquisition cost, our total acquisition cost, by our index factor. We've been given an index factor of 1.10. So our index factor is 1.10 times 1.10. We close it, minus the selling cost that we are given. In this question, our selling cost is 5,000. So we say minus 5,000, then equals. Okay. Then boom. Happy birthday, baby. So, like I said, it's very easy. From your question, identify the sale value. Determine the total cost of acquisition. The total cost of acquisition is made up of these costs here. They will tell you that a property costs whatever and the acquisition cost was whatever. That makes up the acquisition cost. You add those two and you multiply them by your index factor. That should give you your index cost of acquisition. And then you subtract the selling cost. You would have what? Your capital gain is the sale value minus the index cost of acquisition minus the selling cost. Okay, yeah, let's move on to another question. So question 3, accounting profit is 900,000. Depreciation is 120,000. Fines are 15,000. General provisions are 25,000. A specific bad debt allowance is 40,000 and capital allowances are 100,000. What is the taxable income? Now here, this is corporate tax. This ain't no indexation. This is corporate tax. So we want to calculate the taxable income. To calculate the taxable income is very easy. Use this formula here. It's your accounting profit plus your disallowable allowance, your disallowable deductions minus your allowable deductions minus the capital allowances. So the first thing you have to do the first thing you have to do is to identify your accounting profit. Our accounting profit is 900,000. After identifying our accounting profit, you then now add the disallowable deductions. Now, the disallowable deductions, these are items that are not supposed to be subtracted when calculating taxable income, because these are expenses that were not really incurred. So we can't really subtract them to calculate taxable income. that are supposed to be included. We include them by adding them back. So we have to identify our disallowable deductions. The first disallowable deduction from our question here, we have depreciation of 120,000, or rather we add depreciation. We have fines of 15,000, we add fines. We have general provisions. All general provisions are disallowable, we add them back. So we add 25,000. And we have a specific bad debt allowance. Now, that one is a bit different. If an expense is specific, if a provision is specific, like this one is a specific bad debt allowance of 40,000, we're going to treat that one as an allowable deduction. So we're going to subtract that. And then we have capital allowances. You also subtract capital allowances. So remember, for corporate tax, to calculate the taxable income, the formula is as follows. Is the accounting profit, let me zoom in a bit, is our accounting profit plus disallowable deductions minus allowable deductions minus capital allowances. The formula is right here. For taxable income, we say the accounting profit plus disallowable deductions minus allowable deductions minus capital allowances. Oh yeah, I did describe what disallowable deductions are. I didn't describe to you what allowable deductions are. With allowable deductions, these are expenses that are supposed to be deducted when calculating the taxable income. Yeah, I will leave it like that. Now let's go to solving the question. I already have the formula right in front of us. Let's plug numbers. We start off with the accounting profit. The accounting profit is 900,000. I do hope you are writing as I'm saying all of this. Don't watch this like a movie. This ain't no movie. It's a tutorial video. You write as I'm instructing you to write. It's 900,000 as our accounting profit plus 120,000 plus 15,000 plus 25,000 minus 40,000 minus 100,000. That's 900,000. Let me add these in brackets. That's 900,000 plus, we are adding allowable deductions. It's our accounting profit plus the disallowable deduction. Plus the disallowable deductions. So it's 900,000 plus depreciation of 120,000 plus fines of 15,000 plus general provisions of 25,000. We close that in the bracket, and then we less allowable deductions. We less the specific bad debt allowance of 40,000 minus 40,000 minus 100,000. Boom. Yeah, that should give us this figure over here, 920,000. It's our accounting profit plus the disallowable deductions minus the allowable deductions minus capital allowances. I hope we are all getting the same figures as we are calculating. Now let's move on to the next question. We go to question 4. Okay. A company has a chargeable income of 480,000 before donations. What is the maximum approved donation deduction? So you don't have to think hard about a question like this. Now this is where your theory game needs some re-up. So The question says a company has a chargeable income of 480,000 before donations. What is the maximum approved donation deduction? There's a limit of 20% of chargeable income. There's a limit of 20% of chargeable income. Horar, we multiply our chargeable income by 20% to get the maximum approved donation. Okay, it's 20% of chargeable income. Oh yeah, and I'm supposed to do this. Is 480,000 times 20%. That's 96,000. Then boom, it be like that. Okay. Then we move on to question 5. A loan of 500,000 is granted at 7% when the prime rate is 11%. The loan runs for 6 months. What is the taxable loan benefit? Now, this is easy. We take this straight from employment tax. To determine the loan benefit, what you do there is you multiply your loan amount times the prime rate minus the market rate for the loan. That should give you what? That should give you a loan benefit. Now, take note that they say the loan runs for 6 months. We're going to have to multiply that by 6 months. So ideally, the formula is for, we say loan benefit is equal to the loan amount times the prime rate minus the market rate of the loan times x over 12. I run here, they've denoted that it's in months, so it's x over 12. So in this instance, it will look a bit of something like this. That's the loan benefit times, that loan benefit equals the loan amount times the prime rate minus the market rate times x over 12. Now, we'll just do it here. Okay. We have our loan amount. Our loan amount is 500,000 times, that's 7% and 11%. The prime rate, okay, the market rate is 7%. The prime rate is 11%. So that's 11 minus 7. 11 minus 7, I assume that's a 4. So here we have 4%. I'll say 500,000 times 4%. 11 minus 7. Okay, that should give us a solid 20,000. Then we multiply it by 6 months. 6 months. 6 months is 6 over 12. Okay, that gives us a 10,000. Okay, so there it is. Is the loan benefit equals the loan amount times the prime rate minus the market rate times x over 12. 500,000 times 11 minus 7% times 6 over 12. That should give us 500,000 times 4% times 0.5, giving us 10,000 pula as our loan benefit. Okay, yeah, we move on to the next question. A rated house has a rateable value of 240,000. The employee's annual salary is 40,000. What is the taxable housing benefit? Now here, your theory game has to be intact. You have to understand that with the housing benefit, we compare 10% of the basic salary with No, we compare 10% of the rateable value of the house with 25% of the basic salary, and we choose the lower of the two. In other words, we take 10% of the basic salary or the annual salary as it is given. We take 10% of 40,000 and we compare it with, fuck that. We take 10% of the rateable value. Here the rateable value is 240,000. That's our rateable value. A rated house has a rateable value of 240,000. So we take 10% of 240,000 and we compare it with 25% of the annual salary. Or rather, we compare 10% of 240,000 with 25% of 40,000. Okay, so there's the formula. For the housing benefit, we compare 10% of the rateable value with 25% of the basic salary. From our question, the rateable value is 240,000. So we take 10% of 240,000. And then we take 25% of the basic salary and we compare and pick the lesser of the two. 10% of 240,000 is 24,000. 25% of 40,000 is 10,000. So here, that means that our housing benefit is 10,000. You dig? Oh yeah. Let me do this so that you see what I'm talking about. Let me not just be reading stuff for you. It's 240,000 times 10%. Okay, that's 24,000. Then we take 25% of the basic salary. Is 40,000 times 25%. That's 10,000. And we pick the lesser of the two. That's our housing benefit. Okay, then we move on to the next question. An unrated house has a floor area of 1,000 meters squared, of 1,000 square meters. The employee's annual salary is 50,000. What is the taxable housing benefit? You see, these houses are different, and the way we are going to treat them is very different. In question 6, we had a rated house. Where we compare 10% of the rateable value with 25% of the basic salary. Now we are dealing with an unrated house. With this one, to get the housing benefit, we are going to compare 25% of the employment income. In this case, 25% of the annual salary, and we compare it with the floor area times 250 times 8%. That's how we always do it. Is the floor area times 250 times 8%. Then we pick the lesser of the two. Take note of this formula. Please take note of it. Is 25. We compare 25% of the annual salary with the floor area times 250 times 8%. We make a comparison of the two and we pick the lower of the two. So in this case, we take 25% of the basic salary, of the annual salary is 50,000 times 25%. That should give us 12,500. Now we compare it with the other figures on the side. Here our floor area is 1,000 square meters times 250. I said we multiply the floor area by 250 times 8%. Wait a minute. Let me bring down the zoom a bit. That's 250 times 1000 times 8%. That should give us 20,000. So that means we are comparing 12,500 and 20,000. We're going to pick the lesser of the two. We don't even have to think about it. We are slick as fuck. The lesser of the two is 12,500. That tells us that the housing benefit for this unrated house is 12,500. Oh yeah. Is 12,500 pula. That's the housing benefit. We move on to the next question. Then here we are told that a resident company pays dividends of 150,000 to a non-resident company holding at least 25% of the shares. What is the withholding tax? So yeah, please take note of this. This is where your theory kicks in again. When a resident company pays dividends to a non-resident company holding shares equal or greater than 25%, the withholding tax rate is 7.5%. So let's repeat it again. When a resident company pays dividends to a non-resident company holding 25 holding greater than or equal to 25% of shares, the withholding tax rate is 7.5%. Okay, and here at the non-resident company is holding at least 25%. The inequality says greater than or equal to 25%. That means they'll be paying a withholding tax rate. That means a withholding tax rate of 7.5% will be applied. So that's 150,000 times 7.5%. 150,000 times 7.5%. 11,250. That's the withholding tax they would have to pay. This only applies if the non-resident company is holding at least shares greater than or equal to 25%. That's when the tax rate is 7.5%. That's when the withholding tax rate is 7.5%. Okay, yeah. Now let's move on to the next question. A machine costs 300,000 and qualifies for 15% annual allowance. It is sold after 1 year for 280,000. What is the balancing charge? The balancing charge occurs when the proceeds of sale are higher than the tax written down value. This means we're going to have to calculate a couple of stuff here first. The first thing we're going to have to determine is the actual allowance for that machine. A machine costs 300,000 and qualifies for 15% annual allowance. We're going to have to calculate the annual allowance for the machine. So to calculate the annual allowance, we say cost times the rate for that certain allowance. That's 300,000 times 15%. 300,000 times 15%. That means our allowance charged is 45,000. Now that we have the allowance, let's determine the tax written down value. To determine the tax written down value, we say the cost minus the allowance. You already have the allowance here again. Let's do this. You already have the allowance there as 45,000. Motherfucker. Okay, let me just start afresh. So is the cost 300,000 minus 45,000. 300,000 minus 45,000 is our cost minus our allowance to give us what? The tax written down value. Here we have the tax written down value of 255,000. Now we want to determine the balancing charge. I said for the balancing charge, if it's really a balancing charge, the proceeds should be higher than the tax written down value. So our proceeds here is 280,000. Our proceeds there is 280,000. So I'm going to say 280,000 minus 255,000. Minus 280,000 minus 255,000. That's 25,000. We have a balancing charge of 25,000. There it is right there. You first start by determining your annual allowance. It's your cost times the rate. That's 300,000 times 15%. We get 45,000 pula. Then we determine the written down value. That's the cost minus the allowance. Our cost is 300,000. The allowance we calculated was 45,000. That gave us 255,000. I said for our balancing charge is our proceeds from sale minus the written down value. 280,000 from proceeds minus 255,000, giving us a balancing charge of 25,000. Now on to the next view. On to the next on to the next question. I was about to say to the next video. A commercial building costs 800,000. What annual allowance is claimable at 2.5%? I said to get the allowance, to get any allowance, you say your cost 800,000 times the rate that you are giving for that allowance. They'll give it to you, but you can know them by heart. They're not that difficult to remember. It's your cost times the rate. 800,000 times 2.5%. That should give you 20,000 is the cost times the rate. Okay, let's move on to the next question. An industrial building costs 400,000 using 25% initial allowance and 2.5 annual allowance. What is the total first year allowance? For an industrial building, it qualifies for two allowances. It qualifies for the initial allowance and the annual allowance. To get the total allowance, we say the initial allowance plus the total initial allowance plus the annual allowance. This is how we calculate it. We take them step by step. We start off with what? We start off with the initial allowance. I said to get the allowance is the cost 400,000, the cost times the rate 400,000 times 25%. That's 100,000. Take note of that. Write that somewhere. That's 100,000. That's what? That's our initial allowance. Now we calculate the annual allowance. 400,000 times 2.5%. That's what? That's 10,000. So we have our initial allowance as 100,000 and we have our annual allowance as 10,000. We now want to determine the total allowance is 10,000 plus 100,000. That's 110,000. That's our total allowance. There we go. We start off with the initial allowance, cost times rate, 400 times 25%, 100,000. Annual allowance, 400,000 times 2.5%, that's 10,000. Then our total allowance for the first year is 100,000 plus 10,000, giving us a total of 110,000 as our total allowance. So we move on to the next question. Accounting profit is 700,000. Depreciation is 60,000. Fines are 10,000 and capital allowances are 90,000. What is the taxable income? Very, very easy. I said for corporate tax, it's our accounting profit 700,000 plus the disallowable deductions plus depreciation plus 60,000 plus fines 10,000 minus the capital allowances 90,000 minus 90,000. That's 680,000 pula. You see? Very, very, very easy. You can even do it without writing anything in your test, just by punching and flicking your calculator. You should be done with it. But take note of this formula. Is the accounting profit plus the disallowable deductions minus the allowable deductions minus the capital allowances. If you are able to identify which is which, you should have no problems. To do that, make sure you consult your theory. You read your notes to know the different kinds of disallowable deductions, the different kinds of allowable deductions, so that it feels like a walk in the park for you. You dig. Then the next question. What is the resident company tax on 680,000 taxable income? For a resident company, they basically charge 680,000 times 22 times 22%. Yeah, it's 600 and what did I write over there? It's 680,000 times 22%. Hey, it's 149,600. Yeah, bear in mind those zeros. If you leave out a single zero, it will give you a very different figure than what you are supposed to get. But yeah, it be like that. If you want to calculate the tax payable for resident companies, you just multiply your taxable income by 22%. Yeah, so for resident companies is 22%. For manufacturing companies is 15%. And for non-residents is 30%. Take note of that. To get the tax payable, you just multiply your taxable income by that relevant percentage, by that relevant tax rate, depending on whatever they are asking you to calculate. Here they were looking for the tax payable for residents. We multiply by 22%. Okay, now let's move on to the next question. Okay, yeah, let's continue. Shares are bought for 60,000. Acquisition costs of 4,000. They are sold for 100,000. Selling costs are 2,000. What is the taxable share gain? Now remember this. Like I said in the previous question, with shares, we don't apply indexation. Indexation doesn't apply when it comes to shares. We just take 75% of the share gain. We take 75% of that. So to calculate the gain, it's our sale value. Our sale value, nice visible. It's our sale value of 100,000 minus our cost of acquisition of 60,000 and 4,000, minus our cost of acquisition of 64,000 minus the selling cost of 2,000 times 75%. So it's our sales value. There's the formula there. It's our sales value. Our sales value is, where is it? Yeah, there it is. It's 100,000. It's our sales value of 100,000 minus our acquisition cost of 64,000 minus 64,000 minus our selling cost of 2,000. We'll then get what? We'll then get a 34%. We'll then get 34,000. Like I said, with shares, indexation does not apply. You just take 75% of the gain. You take 75%. That should give us 25,500 as our share gain. Here's the note again. For shares, no indexation applies. Instead, only 75% of the gain is taxable. Okay, we move on to the next question. A property is bought for 300,000. Acquisition costs are 15,000. The relevant index factor is 1.20. It is sold for 420,000 and selling costs are 10,000. What is the capital gain? Here, the formula is very simple. It's the sales value minus the index cost of acquisition minus the selling cost. Then easy does it. We have the sale value of, where is it? Where is it? We have the sale value of 420,000. That's our sale value. 420,000 minus our index cost of acquisition. Our index cost of acquisition is like this. It's 300,000 plus 15,000. That should give us 315,000. That's 300,000 plus 15,000. That should give us 315,000. That's the acquisition cost. Now we are looking for what? The index cost. So we multiply the acquisition cost by the index factor. Our index factor is 1.2 times 1.2 minus our selling cost. Here our selling costs are 10,000. Then we get 32,000. As easy as I was showing you. You see, you don't even have to write too much. You can just solve it all in your calculator. So this is how you basically break them down. It's your sales value minus your index cost of acquisition minus the selling cost, and that should give you what? Your capital gain. And yeah, like that we are done. Easy does it. Peace and love.